When it comes to returns, 100% growth stocks can get you the biggest bang for your buck. Fasten your seatbelts, folks. This is going to be a good one. Growth stocks are shares in companies that are expected to grow at an above average rate because instead of paying out dividends, those profits are pouring back into the company, spurring even more growth, and as a result, higher share prices. The primary appeal of growth stocks lies in the potential for substantial capital appreciation. Investors are attracted to those stocks in the hope that the stock price will, increase significantly over time. This increase in stock price can lead to significantly higher returns for investors compared to those investing in dividend-paying stocks, especially in the short to medium term. The comparison with dividend stocks is crucial here. Dividend stocks typically belong to well-established companies with a consistent record of distributing a portion of their profits back to shareholders, and while you guys know the form of dividends, while these stocks offer the advantage of regular income, their potential for large capital appreciation is generally lower than those of, growth stocks. This is because dividend-paying companies often prioritize returning those profits to their shareholders over reinvesting heavily in expansion opportunities. That sounds great. However, investing in growth stocks does carry some risks. Because the value of growth stocks is largely tied to future expectations, they can be more volatile and susceptible to market sentiment as well as some economic changes. Also, if a growth company fails to meet their expectations, its stock price can decline rapidly. Blue chip dividend stocks do tend to be more stable and less volatile as they are often rooted in established business models with consistent revenue streams. Growth stocks are, of course, more popular with younger investors who have time to wait out market downturns. It is a common strategy for a younger investor to utilize a heavy weighting of growth stocks in their portfolio. Join the conversation. Let us know in the comments if you have any 100% growth stocks in your portfolio. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. For today's list, we are looking only at 100% growth stocks, so all of these stocks will not have any dividends at all. I have also excluded any stocks that do not have at least a current price of $5. Today's list is sorted by their 2003 return on investment, so without any further ado, let's do this. Kicking off this list, we have Colibri Global Energy with a ticker of KEI. They are based out of, California, and they are an oil and gas exploration company based mostly in the US. They have a presence on the TSX as well as the NASDAQ in the US under the ticker KGEI. Their market cap comes in at $211.60 million, and they've got a very volatile beta of 2.32, so that's more than twice as volatile as the market average. Their earnings per share, they come in at 0.91, and they have a price to earnings ratio of 6.53. Their return on equity, that comes in at 16.13%, and they have a debt to equity ratio of 11.71%. Without any dividend, we'll just jump right into those return on investments. Their 3-year return on investment comes in at a very nice looking 90.74%. The 1-year return on investment comes in at 40.40%. And that 2023, so year-to-date return on investment, that comes in at a nice looking 31.82%. This is a company that has been growing well, even when the energy sector struggled last year. With energy on a rebound, this is a company that will more than likely do very well in the future. Coming in at number 4, we have Shopify with a ticker of SHLE. Shopify is a huge online retail point of sale giant. Interestingly enough, we have seen this one about a month ago, but since then, we have new data and they are still improving. So their market cap comes in at $108.79 billion. Just a month ago, it was $88.99 billion. So you can see where that improvement's coming in. Their beta, very volatile, 2.08. Their earnings per share, it is in the negative 1.24, but a month ago it was negative 2.08. So that has improved as well. We do not have a PE ratio, and if we did, it would definitely be negative as their earnings per share is negative. Their return on equity comes in at negative 13.53%. Once again, this has improved big time over the last month. Last month, it was negative 25.04%. Their debt to equity ratio, a very nice looking 13.54%. That also improved. It was 15.20% a month ago. So I like what I'm seeing with the direction they're going in. On their returns, of course, no dividends, but their 3-year return on investment, negative 52.23%. But mind you, once again, a month ago, negative 77.29%. So this is looking better. Their 1-year return on investment, 36.44%, and their 2023 return on investment comes in at a nice looking 42.38%. This is a company, despite the negative numbers, that may be a good one to keep an eye on for sure. Shopify has improved their fundamentals across the board from last quarter, and that is not walking in the right direction. It is more of a jog. Taking our third spot, we have Celestica Incorporated with a ticker of CLS. They are based out of Toronto, and they are an advanced technology, connectivity, and cloud solutions company. They have a market cap of $4.19 billion, a very volatile beta at 2.23. Their earnings per share comes in at 2.32, and they have a price to earnings ratio of 15.14. That return on equity, that comes in at 12.27%. And once again, not a bad looking debt to equity ratio at 45.52%. No dividend. The 3-year return on investment, that comes in at 73.52%. Their 1-year return on investment comes in at 56.01%. And year to date 2023, that return on investment comes in at 56.18%. These are starting to look good. Canada does not have a huge tech sector, but this is a company that for many, it has flown under the radar. But with growth like this, they may become much more recognized in the future. In our almost top spot at number 2, we have the Bitcoin Fund with a ticker of QBTC. This is a closed-end fund and not one of Canada's spot Bitcoin ETFs. They do purchase Bitcoin, and then they provide shares to their investors that will fluctuate in price based on, well, the demand for the fund, as well as the underlying price of Bitcoin. The advantage to this over a spot Bitcoin ETF is that the demand for the fund can increase with declining Bitcoin value, thus insulating the investors from, well, at least a portion of the falling prices of Bitcoin. When you see the return on investments over the last 3 years, you'll see that this is actually working fairly well. Their market cap comes in at $854.21 million. They've got a very volatile beta of 2.26. Now, where this is a fund, we don't have an earnings per share or a price to earnings ratio, a return on equity, or even a debt to equity ratio. So we're going to skip right ahead to the returns. They have, of course, no dividend. Their 3-year return on investment has been at 42.73%. Their 1-year return on investment is at 60.77%. And that 2023 year-to-date return on investment comes in at 59.50%. Looking at these returns, I do like what I'm seeing, but the one downside to this stock is that you will have, of course, a smaller trading volume than simply owning the asset outright. In our top spot at number 1, we have Source Energy Services with a ticker of SHLE. They are based out of Calgary, and they are a company primarily involved in the production, supply, and distribution of northern white and Wisconsin frac sand, a key material used in hydraulic fracturing in the oil and gas industry. They have a market cap of $93.87 billion and a very, very volatile beta of 2.59. Their earnings per share comes in at 0.16, and they have a PE ratio of 43.31. That return on equity comes in at 11.68%, and their debt to equity ratio, really high, 805.4%. Now, keep in mind, their debt's not that big. Their debt's $156 million. Normally, this would scare me, but this is also a company that has just become profitable, and they are estimated to more than double their earnings in the next year alone. They, of course, have no dividend, and when we look at their 3-year return on investment, that comes in at 88.74%. The 1-year return on investment comes in at 77.20%, and that 2023 year-to-date return on investment comes in at a very nice 74.03%. Holy banana bread, that is really good. This is a stock that has recently been a penny stock, and you have to take that into consideration when talking about their fundamentals. They do look primed to explode in a good way over the next few years, and I, for one, will keep my eye on this one. These are some pretty nice looking growth stocks that have a lot of potential to continue padding some very nice capital appreciation. They put up some very nice return numbers, and many of them would fit into a total return portfolio even without the dividends. As usual, if you are interested in any of these stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on Brookfield Corporation, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.